Hi, and welcome to Commercial Real Estate Talk on the Don't Sign the Lease podcast. I think that's what we're going to go with, right? It's the Don't Sign the Lease podcast. What do we do here? We talk commercial real estate. Thank you for tuning in to this weekly look at commercial real estate. We track commercial real estate so you can focus on your business. That's what we're about. And Commercial Real Estate Talk, if you haven't gone yet to our YouTube channel, by the way, these podcasts are now available on the YouTube channel. We've got 1, 2, 3, 4, 5, the last 4 or 5 of them on the channel. We're also introducing a weekly short. My son is still trying to teach me how to upload and do these shorts, but the first one's up. Unfortunately, YouTube didn't recognize it. Somehow I messed something up, most likely on my end. But the first one that we did is how to calculate a parking ratio. And the intent of these shorts is to simplify commercial real estate. In fact, that's going to be kind of our logo or slogan, Commercial Real Estate Simplified. There's a great need out there for business owners to get quick, pithy answers to their commercial real estate. And I figure video, YouTube, shorts, LinkedIn, this is a very easy way to do it. And I very quickly came up with about 50 shorts that we can do over the next year explaining real estate. Again, how to calculate a parking ratio. I don't want to steal thunder. Please go and watch the video. 1 minute, you can figure that out. Second thing, please like and subscribe. Not only this podcast, but to the YouTube channel. We want to get our subscriptions up. That will help us. That will help push out commercial real estate simplified and valuable information out to the business community. So I ask that you would do that. I've got it listed on our screen right now. If you're watching the podcast, you can see we've updated all our marketing, our logos, and so forth. Commercial Real Estate Talk with George Morales, Commercial Real Estate Talk, News Deconstructed. So I encourage you to do that. This is episode 125. Episode 125. It's called Office Sector Woes Part 5. Office Sector Woes Part 5. And really, it's pending commercial real estate disaster, right? Pending commercial real estate disaster. I am writing that title as we speak because a lot of the articles that came out this week nationally are continuing to just rain on the parade of office. Office. You are under attack. And we are a little hedged in here in South Florida, especially Miami. Times have never been better. We have so many folks coming in here. We have actually a lack of housing supply, high-paying jobs. So even though articles this week came out and talked about how unaffordable housing is for most, but in terms of jobs and demand, no problem down here in South Florida for most of the markets. And I'm talking Brickell, downtown, Coral Gables, Coconut Grove, Aventura, so forth, Wynwood, Miami Beach. But for the rest of the country, what they're talking about is, what are we going to do with all this office space? And so we're going to get into that. But before we do, please, again, if you haven't visited us on LinkedIn, go to the LinkedIn corporate page. We updated the channel on LinkedIn or the LinkedIn profile to Commercial Real Estate Talk, which is the Don't Sign the Lease page. Please hit us there and follow us. Also follow us at Blue Box Real Estate. That's how we pay the bills. Blue Box Real Estate, we're an independent commercial real estate firm specializing in tenant advisory services, landlord advisory services, and investment sales. Established in 2017, praise God, been around for 7 years, offering expert advice to the local markets. And I don't say that just in passing, because in my career, I've spent 10 years at a national firm, the second largest at the time. It was the largest, now the second largest publicly traded provider of commercial real estate. And after 10 years there as a VP, and a lot of the book of my, especially the last 3 years that I was there, was self-driven, really providing value to the local markets. I wanted to bring that level of expertise and experience to South Florida markets. And now we're stretched into Orlando, Port St. Lucie, Tampa, so really throughout Florida. So contact us, please, if you need any commercial real estate solution, any commercial real estate advice. If we're not the best suited for you, and then we'll be open and honest about that, but we will put you in contact with those who are. So please reach us at blueboxre.com. Let's get right into the podcast. With that said, we might have a few other pauses here. And Office Sector Woes Part 5, CBRE. This is from Biz Now. Artificial intelligence to take a big bite out of demand for office space. This is a big issue. You're going to be surprised as I get into this because, this headline I think we're all expecting, right? Especially those of us in the sector. We've heard a lot about artificial intelligence, how it's going to replace everything. You watch Terminator, The Matrix, and they're going to take over the world. Don't worry, folks. Don't believe any of that. But CBRE says artificial intelligence will take a big bite out of office demand. Now, that could be the case, but you'll be surprised what they mean by big bite. Office buildings across the country are facing the lowest occupancy on record, and more than 1 billion square feet is at risk of becoming obsolete. But another existential threat is just around the corner. Now, usually when you hear existential threat, they're talking about like rising sea tides and so forth, but that's not what they're talking about here. They're talking about artificial intelligence, but this is a huge statement right off the bat. Office buildings are facing their lowest occupancy on record. Now, it's been 4 years since the pandemic or plandemic, some might say, and Fauci still, this week was at Congress having to give an account. Obviously took no responsibilities. Mask on, mask off, take this jab, take 2 jabs, take 3 jabs, take 4 jabs, stay 6 feet, stay 3 feet, stay indoors, go outdoors, get sunlight, don't get sunlight. I mean, folks, we were like running around like chicken without a head on for a year. And it's just wonderful how Fauci, is just completely oblivious to what Americans had to deal with. Close your business, open your business, go to church, can't go to church, sing a hymn, don't sing a hymn. I mean, we were all over the place. And in fact, and I don't even mean to get off topic, but most of the data shows, that was completely ineffective. The biggest one was Mr. Fauci. You certainly shied away from the lab leak theory that you were well attuned to and well involved in. And somehow you're not being held account to that. But anyway, we digress. It's been 4 years since those days, and office occupancy is still, 4 years later, hasn't recovered. Secondly, think about that. Now, I've been in commercial real estate for about 30 years, got into this business in the early 90s. So I saw the recession. I saw George Bush's recession that got Bill Clinton in the White House. I saw the dot-com bubble, remember Y2K, and we all thought the world was going to end because of the flip in the calendars and computers from 99 to 2000 was just too much to handle. But lo and behold, 8 months later, in August of 2000, we had the dot-com bubble, and the economy tanked. And then we had 9/11, not that long after that, and the economy froze for months after 9/11, rightfully so. And then we had the Great Recession, which things feel very similar, right? We had an overstretching of commercial real estate loans, CMBS loans, residential loans, Fannie Mae, Freddie Mac. Remember those terms? Everyone was passing the hot potato, too big to fail, big banks, and Lehman Brothers and so forth, falling, dragged the economy down for years. But none of those produced the lowest occupancy on record for office buildings like this pandemic did. And that's what we're facing. But it's only going to rain more on your parade. According to CBRE, back to the article, artificial intelligence is expected to replace 85 million jobs by 2025, according to a report from the World Economic Forum. That has implications for real estate. CBRE Investment Management Chief Investment Officer for America's Direct Real Estate Strategist, Julie Ingersoll. All right, Julie, I would like to get a business card or see your email letterhead. And maybe I'll look you up on LinkedIn, because how do you fit all that on a little index card? Let me read her title again. CBRE Investment Management Chief Investment Officer for America's Direct Real Estate Strategies, Julie Ingersoll. Woo! That's a big title, Julie, but I'm sure well-deserved. Listen to what they just said. 85 million jobs are expected to be replaced, not at risk. Okay, they're not saying that we might lose. No, they're saying we expect 85 million jobs to be replaced by 2025. Now, I know some of us still think it's 1999, but it's actually, I'm looking at my watch. I mean, it's actually, as this podcast is being released, June 6th, 2024. And they're saying by 2025. Not 2035. 2025. That's 6 months away, folks. We're going to lose 85 million jobs. What do they know that we don't? If we lose 25% of our jobs, the article continues, in the United States, think coding jobs, secretarial, even sales-related roles, that's the downstream impact going to be to an office when we're already at a 55-year high of office vacancy, Ingersoll said at a CBRE IM media event Wednesday. We think it's going to have pretty deleterious impact on office demand. I'm not sure, I have to confess, what deleterious means, but we can assume that's not good, right? I'm saying no. I can't get a quick, I can't get a quick definition. But deleterious has to mean negative. Okay. Some of the sectors that are going to be heavily impacted include regulatory governmental roles and tech, she said, but others may come as surprises. One of CBRE IM students' housing partners recently leased 60% of all its housing to the next academic year using AI rather than brokers and in-person tours. All right, so this can impact brokerage. That's very very unsettling. Think about Zillow. Think about Realtor.com. I don't know about you, but whenever I keep track of the real estate market, residential, it used to be before these things, you would have a friend or a neighbor, and you'd always talk to them. Now everyone's an expert. Even LoopNet. I can't tell you how many of my clients always are sending me things from LoopNet or now Crexi. Granted, these things are self-regulated. The information is very dated. You find a market and the rents are $30 a square foot there, but hey, LoopNet has something at $22. And so you have to go through the research. Your client sent it to you. In a way, it's a trust issue, right? They should probably just trust that you're on top of this, and that you're the expert. But they find this themselves. They send it to you. And sure, you call the broker, find out that he's no longer in real estate. He's living in Tennessee, and that listing is like 3 years old. That's what you get right now. But obviously, it's going to probably improve. And one of the big areas are going to be in the real estate cycle. It's just going to take place. 60% of all its housings for the next academic year were used AI rather than brokers. Municipalities with diverse economies will fare better, she said, but places like with job concentrations of sectors like government jobs in D.C. or tech jobs in Santa Clara may hit another wave of office vacancies just a few years after the pandemic hollowed out demand for office space in those same cities. Now, let's connect the dots. A few weeks ago, we did a podcast where we discussed the government leases is 300-something million square feet. It's some massive number. Maybe it might be upper 290 million somewhere, but they're one of the largest occupiers of office space in the United States is our government. Are you surprised by that at the size of our federal government? That's not what our founders, I believe, intended. And I sure wish we can backtrack on that. Maybe AI will help do that. But right now, the government is averaging 14% office occupancy. And they haven't canceled leases yet. The media, stopped covering this, but for a while, GSA, General Service Administration, which is the real estate wing of the federal government, was talking to Congress and trying to explain why they continue to pay on all these leases. Now, remember, all these leases, for the most part, have termination options, so they can get out of these leases if they want. They haven't, I suspect. These landlords are probably big donors, and the same congressmen who accepted those donations for their campaigns probably aren't going to go around and bite the hand that fed them. That's my guess. But 14% office occupancy in hundreds of millions of square feet. AI by 2025 might even wipe out a lot of those government jobs. And look, let's face it, if it's probably it's probably okay. Anyway, I'll keep quiet. I was going to go down a direction about government jobs, but that's one area. DC is going to be heavily felt. Tech jobs, obviously. Maybe hit with more vacancies, okay? Diversification is key, says the article. We kind of saw this in the lockdown and in the coming back to office movement, said Wei Lu, Director of Research at CBR Investment. Seattle, San Francisco are good examples of cities where the concentration of tech workers are more likely to work remotely than those in financial legal roles. And we have an article talk about the legal professionals resulted in difficulties for the office sector that persist today. All those tech centers got hit very hard, Lu said. While it's unclear which jobs will be replaced by AI, when the repetitive nature of coding means some of those same cities could be at risk. All right. Now, I found a little kind of a little air leak in this article, right? 85 million jobs are expected to be replaced in the next 6 months. You read the article, we're about 7 or 8 paragraphs down, and we read this. It's unclear which jobs will be replaced by AI. Well, I mean, if it's unclear which jobs will be replaced by AI, how can you make such a bold declaration that 85 million are going to be replaced? Hey, we're not sure which ones, but something's going to be replaced. We're not sure. Sometime in the future, and about in 6 months. 6 months, we're going to lose 85 million jobs. Which jobs, sir? I don't know. Okay, well, so take the article for what it's worth. It's maybe some of that is clickbait. I don't know. This is from CBRE. They're legit. They're a large global, corporate real estate group. But it is. I do think it is. I would. My guess is it's not 2025. It's probably closer to 2030. 5 or 6 years. Look, you can't even go to a fast food anymore. You can't even go to Publix. Now I go to Publix, which is our local grocer here in Florida, and you got to self-check out. So you're paying more for your food, and now you're an employee of Publix as you get to scan. After the first couple times, you're like, oh, hey, that was fun. But after a while, you're thinking, wait a minute, I don't work here. Why am I running this cash register? Why am I scanning my own food? Didn't you used to do that? Why am I? And you're even bagging your own food, okay? You bring the milk, bring the egg, bring the cheese, and I got to figure out how it goes into those plastic. It's actually just plastic, right? No more paper. Plastic bags, and then get your receipt, give it to yourself, and put it in your own bag and take it with you. So you're paying the same amount. Actually, you're paying more to do it yourself. So maybe is that AI or is that just automation? Maybe AI stands for automation inclusivity. I don't know. I think AI sometimes has become a term, and they're even capitalizing it, right? That is so it could stand for anything now. Oh, it's AI. Well, we used to. I remember as a kid. Do you remember as a kid? Those of you, I'm going to date ourselves. When you go on the Palmetto or the Turnpike, remember toll booth operators? You had to throw in your quarter, and then after a while, there'd be a guy there or a girl, and she actually stick her hand out, and you put the quarter in her hand, and then she would drop it in the basket that's about 10 feet wide. I'm exaggerating, but you couldn't miss this basket. But you had people there getting your quarter from your hand and then just literally just dropping it, not even moving their hand. And, well, where did those jobs go? Automation, right? We went with SunPass, wiped all those jobs out. Was that AI 30, 20 years ago? So maybe we're attributing too much to AI and not enough to just automation and remedial work. And again, for the young people in the audience, don't pursue a career or job that can be replaced by automation or AI, whatever this AI is, right? I mean, for instance, web designing. You can go on any platform today and within half an hour, design your own little drag and click website. Coding. The program. You can program a code to code. So there are certain jobs, and I would argue government data entry or customer service. There's a lot of jobs that are in danger to this. Now, I just kind of thought about India, right, or some of these places where a lot of customer service cold call centers have been farmed out. That could be in danger. Because you can invent programs and coding to answer questions, and sometimes you don't even know if you're talking to a human or a machine. But there's no doubt going to be impact to these remedial jobs. Are attorneys going to be replaced? No. Are accountants? Maybe. Maybe accountants will be replaced in some lower level in terms of, not lower, but just generic counting. Someone just has a normal job and not a lot of businesses and side hustles and properties, and they just work 9 to 5, come home. Yeah, you probably can go online and do it right now anyway. You don't need an accountant. Brokers, are we going to be needed? I believe so. I believe there's still going to be that expertise that needs to be given on a local market, how to develop, what to develop, a tenant mix, market rates, market comps, what's being negotiated in leases, how to protect yourself, how to negotiate against the landlord. AI is not going to take a fiduciary relationship with you, representing your office needs, your lease, your retail needs, finding, hustling. So a lot of it can be done. Now, a good broker will start implementing those things into their process. But anyhow, that we kind of labored this to the point here. Artificial intelligence, they're planning in the next 6 months to take away 85 million jobs. And again, I doubt it'll be 85 million. Let's put a pin on it, and let's come back, God willing, next year and take a look and see what the damage is. But listen, 25% of the job market being wiped out in 2025, we're all going to know this, all right? Whether I'm still doing this podcast, whether you're still working in what you're doing, you can't miss a 25% job market law. I mean, we're talking Great Depression job loss, right? So we'll take a look, and then all the domino effect that takes place from that. All right, let's go to the next office sector woe. Past due commercial real estate loans, this is from BizNow, increased 9% to the highest level in over a decade. You notice we keep hitting this. Here's highest level commercial real estate loan past dues. We also have the highest level of vacancy or not vacancy, of office occupancy, right? People coming into the office. And now here we have another one. The amount of past due commercial real estate loans in bank portfolios has skyrocketed even as the banking industry has seen profits grow, new federal data shows. Past due non-residential commercial real estate loans last quarter increased by $1.8 billion or 9% from the prior quarter, according to a quarterly report from the Federal Deposit Insurance Corp, the FDIC. However, the bank industry saw a rebound of net income to $64.2 billion in the first quarter, a 79.5% increase from the prior quarter. Weak demand for office space is softening property values, and higher interest rates are affecting credit quality and refinancing ability of office and other types of commercial real estate loans. FDIC outgoing chairman Martin Gruenberg said, according to CoStar, as a result of the non-concurrent rate for non-owner-occupied commercial real estate loans is now the highest level since fourth quarter of 2017. Largest banks, those with assets greater than $250 million, which is not a lot. I mean, for a bank, that's not a lot, saw a past due of non-accrual rate of 4.48%, well above the pre-pandemic of 0.59%. So before the pandemic, defaults, past dues, under 1%, right? 0.59%, well under 1%. Now they're 4.5%. That's a huge increase. For banks with assets between $10 billion and $250 billion, the rate was 1.47%, up from 1.35%. So not as noticeably in the larger banks, but it's still an increase from 0.66% pre-pandemic. So if you're going to say which banks are the ones that are at risk, there it is right there, right? It's the banks whose assets are between $250 million to $10 billion, because they have a 4.5% non-accrual rate past due loans. All right, and that is in large part due to the office environment. All right, now here's another article. This one's from Globe Street. These banks are overexposed to CRE. So this goes a little bit more into the weeds. 67 banks with CRE exposure greater than 300% of the total equity. Flagstar Bank and Zion Bank Corporation are chief among the 67 banks in the U.S. that are increased risk of failure due to their commercial real estate exposures, according to data analysis from the finance expert at Florida Atlantic University. A little props to our local university here in Boca Raton. Flagstar Bank reported $113 billion in assets with a total CRE of $51 billion. That's almost half. The bank, however, has only $9.3 billion in total equity, making its exposure to CRE 553% of its total equity. Whew. So Flagstar Bank, right, has an exposure of $51 billion in commercial real estate loans, and they only have $9.3 billion in total equity. That's a problem, right? How about Zion Bancorp? Total commercial real estate of 440% of its total equity. The bank reported $87 billion in assets and a total of $26 billion in CRE loans. Only $5.8 billion in total equity. So, maybe this is a lesson for some of us, or a wake-up call. Just because the bank just because you put your money in the bank doesn't mean it stays in the bank, right? This is so. Flagstar Bank has $9.3 billion in equity. I assume that's like cash in hand in their vault, right? To make it simplified, but they've lent out $113 billion. So do the math. That's 10x, right? So for every $1 you give them, they're putting 10 out there in the economy, and of that 10, half of that is in commercial real estate loan. So your $1 has been put out there into the commercial real estate sector, and that's a big problem right now. And you may wanna talk to you may want to talk to the bank. You may want to reach out to Flagstar and say, I'm thinking of going to, I don't know, Truist or another bank. And Zion Bancorp, same thing. These are the two largest banks with excessive exposure to commercial real estate, said Rebel Cole, professor of finance at FAU's College of Business. Both rely heavily on uninsured deposits, which make them vulnerable to a bank run similar to what forced regulators to close three large banks in the spring of 2023. Those bank closures have led to concerns about stability of the U.S. banking system. That persists today. Now, I won't continue talking, we're about halfway through the article, but let me read the last paragraph because I think it's relevant. Banks with less than $10 billion in total assets are facing similar risks due to commercial real estate exposure. Among banks of any size, 1,871 have total commercial real estate exposure greater than 300%. That's a lot of banks. Did you realize we had that many banks? 1,112 have exposures of greater than 400%. 551 banks have exposures of greater than 500%, and 243 banks have exposures greater than 600%. That's a lot of banks. Now, I think I might even reach out to whoever put Erica Morphy and see if she could send me this list, right? You want to know if your bank is one of these 1,871 banks. Likelihood is that they are. That's a lot of banks are due to exposure to commercial real estate loans. All right, let's keep plugging away. CoStar, auto sales rise, job openings decline, office attendance edges lower. Now, that doesn't make sense to me. This is just the headline. Auto sales are on the rise, but office attendance edges lower. What, are people living in their cars? I mean, they're not using them to go to work, so why are people buying new cars? We're not really going to delve into the auto sales, but it went up from the prior month, 6.4%, and better than April of last year, 3.5%. We're on track for nearly 15.9 million units sold by year end. I don't know, maybe there was a pent-up demand for auto sales. But it says major automakers posting U.S. sales boosts include Ford and Honda. Ford said Tuesday its May unit sales rose 11% from earlier with the help of strong demand for pickup trucks, SUVs, and hybrid vehicles. American Honda said its May sales were up 14%. So there you have it. Auto sales are up, but job openings are declining. The Labor Department Tuesday reported that about 8.1 million job openings on the last business day of April, down from 8.4 million the prior month, and also below 9.9 million end of April 23. So we've seen almost a 10% decline in job openings. Is that because of AI? Does that have anything to do with the article we read before? Let's see this paragraph here. Analysts at research firm Oxford Economics said the latest numbers show demand for workers continue to ease, with job openings falling to their lowest level since February 21. However, layoffs remain low, so net job growth continues to be positive. The quit rates held steady at a level we think is consistent with ongoing moderation wage growth. Now, government data shows private education services posted the largest April increase in job openings from the prior month, 50,000. Healthcare, social care, social assistance category registered steep decline of 204,000. That's probably because Cano Health declared bankruptcy. And anyway, office attendance edges lower. Again, not good. The Memorial Day holiday brought an average big city office visits down 48.4% of their pre-pandemic level in the week ended May 29th, according to Castle Systems' latest tracking. That was down from 50.3% the prior week in the security technology firm's 10-city back-to-work barometer based on anonymous keycard data from Castle. We've heard a lot about them. Office property clients. The average peaked to 53% pre-pandemic attendance. Now look at this chart. Look at this chart, folks. If you're listening to this podcast, pause it, go to YouTube, and subscribe, and look at this chart. Let's go to February of 2020. February of 2020. I'm going. How about that? February 5th, 2020. Average office attendance in the New York metro area was 101.8%. I don't know how that works. How do you have 101.8% of your employees coming to the office? Maybe, I don't know how that works. Maybe that's new hires that haven't started yet. But essentially, everyone was coming to the office in New York. And this chart tracks New York metro area, Houston, San Francisco, Philadelphia, Washington. They're all 98.8, 100.8. San Francisco, Houston, Chicago, 102.6%. I mean, what are people sneaking into jobs they don't have? How do you go north of 100% of office occupancy? I don't know. But and then the pandemic hits, right? March 25th, 2020, and you just see a cliff. Folks, I mean, from 100% down to New York, 4.7% by April of 2020. So that's what the pandemic did. That's what the pandemic did. Everyone is a shutdown, lockdown, shutdown. And I remind you who was president then. Think about that. But all the lockdowns took place March, April 2020. And now you see this new kind of slowly inching up, 27%, 30%, another little dip, another wave, I guess, another scare. It seems like, folks, this chart's very valuable. Every January, it seems like there's a scare and office attendance drop. So you go to November 2020, and we were up to Houston. Let's just use Houston example, 37% office occupancy. But by January, early February, we're down to 26%. And then it creeps back up. It peaks at 54.9% in Houston. But again, February of 22, it's down to 34%. Creeps back up. Houston, 59.6%. But again, January, February, it dips to 43%. And again, 58% November 2023. And then it lowers down again for Houston. Where are you, Houston? There you are, to 41%. So I don't know. Is this scares? Is this COVID scares? Is this people go away, shut down for the holidays? Maybe. But this is all January, February stuff. But isn't it interesting? Maybe someone can dig into these numbers. But a picture's worth 1,000 words, right? And this data shows us that every January, February since the pandemic, office occupancy starts to creep back up and then tanks. It starts to creep back up and tanks. Starts to creep back up and then tanks. So we'll see if that holds. But bottom line is we're still well below that 100% office occupancy that we saw in February 2020. And that's a major problem. That's a major problem. The article really doesn't explain much. But it does show us that beautiful graph. So it talks about maybe weather, holidays. If I recall, maybe 21 and 22, there were other, variant scares of the pandemic. We were all trying to go to keyless or touchless entry systems, and only 2 people in the elevator allowed. I mean, all kinds of stuff were happening. So maybe that has to do with it. But that's not good, because office occupancy needs to rise if we're going to get out of the doldrums of the office sector. But this is far enough of trend, right? We've got 4 years of data, and you can see that we have just peaked. I mean, Houston is at the highest from all these, but Philadelphia, Washington, D.C., New York, well below, 10 points or so below Houston. It's 50%, 48%, 60% in Houston of where it used to be in terms of office occupancy. So that's a continued problem for the office sector. And let's kind of pause the article's discussion there. I think we've gone a little bit long. I had another article here somewhere relating to law firms. Law firms seem to be the one area that one sector that continues to use offices, and that makes sense. I mean, a lot of law firms, you have the big law firms like Greenberg Traurig and Bilzen and Holland and Knight, but there seems to be 20 law firms in every office building in South Florida, and the majority of them are 2 or 3 man firms or women firms, and they're still using their space. They're paying for it. They're still using it. So law firms are continuing to rise. Go figure. Surprise, surprise, right? That law firms are increasing. I think America has the majority of offices of law firms. So we like to end our podcast to cover Reddit. We didn't do this last week or two, but I found an article that I thought, or a question that I thought would be helpful to discuss. And again, there's a commercial real estate section on Reddit. So this is the Reddit hour. I don't have my fancy music set up. Sorry about that. CAM charges 22% of rent. Advice, please, if you have experience. All right. So I guess the question is, that seems kind of high. CAM is 22% of my rent. Advice, please. Now, he goes into a very long-winded, he even breaks down the entire CAM. All right. But essentially, his annual rent totals $113,800, and his CAM is $24,200. Now, off the bat, and I replied, I gave him a reply. Off the bat, it's really irrelevant, folks. We're talking retail leases when we talk CAM. Maybe some office charge triple net rents, but in office you're going to see the term operating expense more than you will see CAM, unless it's owned by a retail owner. But for the most part, we're talking about retail rents. So when you lease a retail space, you pay on a triple net basis. In fact, both of these or 3 of these, or this might be 4 shorts that are coming soon. So I'll give you a little sneak peek. And this is how I answered the question. CAM is a total operating cost of the property that is passed on to tenants based on a pro rata share on triple net leases. In lower market rents, CAM is going to be a higher percentage of your total rent cost. In higher market rents, it's going to be a less percentage. Let's do the math. So remember, CAM is common area maintenance. That's everything included: landscaping, electricity, management fees, whatever's included. Now, sometimes CAM includes real estate taxes and insurance. Sometimes, most of the times, property owners like to parcel that. So you got CAM, real estate taxes, and insurance. So let's go with me on this example. Let's say you're in a market where the rents are a little bit less expensive, and it's $15 a square foot for your base rent, triple net. CAM is $10 a square foot. So your total per square foot is going to be $25, 10 plus 15. All right. So your $10 CAM out of the 25 represents 40% of your total rent. It's skewed because the rent's so low. Now let's use the same $10 CAM, but now you're in a higher rent district and the rents are $50 triple net. Now your $10 plus the 50 is $60 total rent cost. So your $10 CAM only now represents 17% of your total rent factor. So really the percentage of CAM to base rent is irrelevant. What you need to know is, what is your total occupancy cost, right? That's what you need to know. What's the CAM, what's the base rent, and make a decision based on that. There are some markets where it's 1-to-1, but you probably, if you're a retailer, don't want to be in that market unless you're catering, you have whatever, Dollar General store, you're catering to that sector. I don't want to tell you how to run your business, but there's some markets where you could find $10 base rent and $10 CAM, and you're paying 50% of your rent cost goes to CAM. Well, I mean, I'd rather have 50% of my rent costs go to CAM than only 10%. That means you're paying a lot higher base rent. So it depends on your business, depends on where you need to be, but CAM as a percentage of your total rent cost is really irrelevant. It really doesn't matter. There are other things that you need to know about, though, regarding CAM and how to protect yourself, and I cover some of this in the book on commercial real estate office leasing. So there you have it, our Reddit hour question of the day: CAM charges as a percentage of rent. Not really a factor. You just need to know what these charges are and line it up to your budget. All right, well, that's our podcast for the week. Remember Proverbs 20:18, our verse for the podcast: plans are established by wise counsel, wage war. We hope this podcast helps you in that vein. Hope these little short YouTube videos will do. If you haven't followed us on LinkedIn, please do. We're pushing out commercial real estate news, events, new content all the time, so please don't miss us there. And again, if you like this podcast, please give us a thumbs up, hit the subscribe button, and share us with others. Good day. Thank you.